A billionaire can own a skyscraper, collect millions in rent, watch the building climb in value every single year, and still tell the IRS he lost money on it. Not once, year after year. And it is completely legal. So how does someone earn a fortune in real estate and pay less tax than the person who cleans the lobby? Today we follow the money all the way down. Start with the simplest version. When you earn a paycheck, the government takes its cut before the money even hits your account. Wages are the most heavily taxed kind of income in America. But the wealthy rarely live on wages. They live on assets, and no asset in the U.S. tax code gets treated as gently as real estate. Here is the first move, and it is the one that surprises people the most. It is called depreciation. Depreciation is the tax code's way of admitting that physical things wear out. A roof ages, pipes rust, a building slowly decays. So the IRS lets a property owner deduct a slice of the building's value every year, as if it is falling apart in slow motion. For residential rental property, the schedule is 27.5 years. For commercial property, it is 39 years. Divide the building's value by that number, and that is roughly your deduction, every year like clockwork. Now, here's the catch that makes it powerful. That deduction is on paper only. The owner does not actually spend that money. The building is not really crumbling. In most years, it is doing the opposite, quietly rising in value while the owner writes off a loss on it. Real cash comes in as rent. A paper loss goes out on the tax return, and the tax return is the only thing the IRS sees. So a landlord can collect, say, $100,000 in rent, subtract the mortgage interest, subtract the repairs, and then subtract a fat depreciation deduction on top, until the whole thing shows a loss. Positive cash in the bank, negative income on paper. That gap is the first source of the magic. And the rich found a way to make that deduction bigger and faster. It is called cost segregation. Instead of treating the whole building as one slow, 27.5-year write-off, a specialist breaks it into pieces. The carpet, the appliances, the lighting, the landscaping, the parking lot, those items depreciate much faster. Some in 5 years, some in 15. Pull them out, and you can front-load a huge chunk of the deduction into the early years. Then, Congress poured gasoline on it. The Tax Cuts and Jobs Act of 2017 introduced what is called bonus depreciation, which for a stretch of years let owners write off 100% of those short-life items immediately. In year one, buy a building, run a cost segregation study, and you could manufacture an enormous paper loss the very first year you owned it. That provision is now phasing back down, but for years, it was one of the most powerful tax tools in the country. So who actually gets to use all these losses? This is where it gets sharper. Normally, a paper loss from a rental can only cancel out income from other rentals, not your salary or your business income. But the tax code carves out an exception for people it calls real estate professionals. If real estate is genuinely your main line of work, and you meet the hour requirements the IRS spells out, those losses stop being trapped. Suddenly, they can wipe out other income too. This is why you will hear wealthy people say, only half joking, that their spouse does real estate. It can convert paper losses into a shield over the whole household's income. Getting that status wrong is also a favorite target of IRS audits, so it is not the free lunch it sounds like. So far, the owner has collected rent and paid little or no tax on it. But eventually, don't they have to sell? And when they sell for a profit, doesn't the tax finally come due? Here's the second move. They simply don't sell. They trade. Buried in the tax code is Section 703(1). It allows what is called a like-kind exchange. Sell one investment property, and if you roll the entire proceeds into another investment property within a set window, you pay no capital gains tax on the sale. Not reduced tax. Zero for now. The gain doesn't disappear. It just gets pushed down the road into the next property. Do it again, and it gets pushed again. An investor can trade a small building for a bigger one, then a bigger one, then an apartment complex, stacking decades of gains and never once stopping to pay the tax. The IRS calls this deferral. In plain English, the bill keeps getting kicked forward. But a deferred tax is still a tax someday. Unless, of course, someday never comes. And that is the final move, the one that ties the whole thing together. Some tax lawyers call it buy, borrow, die, a phrase popularized by University of Southern California law professor Edward McCaffery. Watch how the three words work. Buy. The wealthy buy assets, real estate above all, and let them grow. Borrow. Instead of selling those assets and triggering a tax, they borrow against them. And this is the part that breaks people's intuition. So, slow down here. A loan is not income. When the bank hands you money, you have to pay back. The IRS does not tax it because it is not a gain. It is a debt. So, an owner can take a property that has doubled in value, get a new, bigger mortgage against it, a cash-out refinance, and pull hundreds of thousands of dollars into their pocket, tax-free, because technically they just borrowed it. They spend the loan, the property keeps rising. They never sold a thing. Then comes the last word, die. And this is the quiet giant of the whole system. It is called the step up in basis. When someone dies and passes an asset to their heirs, the tax code resets the asset's value to its worth on the day of death. All those decades of gains that were deferred, all that appreciation that was never taxed, the capital gains tax on it simply vanishes. The heirs inherit the building at today's value, and if they sell it tomorrow, there is little or no gain to tax. Buy it, borrow against it your whole life, and pass it on. The tax on a lifetime of growth can evaporate at the finish line. Let's put real numbers on it. Simplified to see the machine clearly. Imagine an investor buys an apartment building for $2 million using leverage, which just means using borrowed money. So maybe he only puts in $400,000 of his own cash, and the bank lends the rest. Say the land is worth $400,000 and the building itself $1.6 million. Depreciate that building over 27.5 years, and that is roughly $58,000 a year in deductions, on paper, without spending a dime. Meanwhile, the property throws off real rental income and slowly climbs in value. On the tax return, the depreciation can swallow much of that income whole. Years later, the building is worth $3 million. He doesn't sell. He refinances, pulls out several $100,000 in tax-free loan money, and keeps the building. When he dies, the step-up erases the gain for his kids. Rent collected for decades, cash pulled out along the way, and the tax bill, quietly, close to nothing. This is not a fringe trick. It is how a lot of serious American wealth is actually structured. In 2020, the New York Times reported that Donald Trump, a real estate developer, paid just $750 in federal income tax in 2016 and again in 2017, largely on the back of enormous real estate losses. In 2021, ProPublica published leaked IRS data showing that many of the wealthiest Americans pay a tiny fraction of their growing fortunes in income tax precisely because unsold, borrowed against assets are not taxed as they grow. Real estate is one of the cleanest ways to run that play. Now, the honest part, because honesty is the whole point here. None of these are secret loopholes hidden in the dark. Depreciation, Section 1031. The step up in basis, they are written plainly into the law, and lawmakers put many of them there on purpose, to encourage people to build and hold housing and commercial property. There are real limits, real risks, and real costs. Leverage cuts both ways. When prices fall, debt can wipe an owner out fast, the way it did to thousands in the 2008 housing crash. Depreciation gets partially clawed back if you ever do sell outright, through something called recapture. Real estate professional status draws audits, And the ordinary rental income along the way is still taxed. This is not free money. It is a system that rewards those who already have capital, patience, and good lawyers. And that is really the lesson. The tax code is not one flat rulebook that hits everyone the same. It is a set of incentives, and it is quietly generous to people who own the right kind of assets and can afford to wait. The person living on a paycheck is taxed on money the moment they earn it. The person living on real estate is often taxed on money only when they choose to be, which can be never. So the next time you hear that a billionaire lost money on a building that is clearly worth more every year, you will know it is not a lie. It is depreciation, deferral, and a debt taken against a rising asset. The building didn't lose value. It just spoke the one language the IRS is required to listen to. And now, so do you.